Good afternoon. I'm Emma Howard-Boyd. I am Chair of the Environment Agency and also Interim Chair of the Green Finance Institute. And I'm really pleased that here we are again back in the studio talking about adaptation and resilience. I've got a fantastic panel joining me this afternoon. So on my far right, I've got Rowan Douglas, who's head of the Climate and Resilience Hub at Willis Towers Watson. I've also got Nicola Ranger, who's Deputy Director of the UK Centre for Greening Finance and Investment. And joining us virtually is Luiz Amaral, Director of Global Solutions for Commodities and Finance at WRI. So welcome to this panel. And for me, COP26, right from the start, we have seen adaptation and resilience, preparing for climate shocks, the race to resilience, talked about by world leaders on Finance Day. And Rowan, your Chief Executive, John Haley, was on one of the main panels talking about the Coalition for Climate Resilience Investment and other initiatives that Willis Towers Watson are involved with. Nicola, you've been involved with report launches here as well. And I do want to make sure that I bring you in as well from WRI. What feels different about the adaptation and resilience agenda? And do you think we're now catching up with the race to zero? What more do we need to do to make sure that we are thinking and acting as much on this agenda as we are reducing our emissions? Rowan, let's start with you.
Well, I think you're absolutely right, Emma, and I think it's been voiced already that COP26 will be remembered for sort of finance and economics in the way that Paris was remembered for the politics. So that's definitely one theme that's been growing throughout, I think, our first week here in Glasgow. But you've identified the other themes. So a few of us, haven't we, been coming to COPs for the last few years, and the resilience adaptation side has always been really a very low-key component of a much bigger, broader conversation. But this year, it's different. A bit like the finance story, it's usually themed around resilience, certainly for the business and sort of general community, but it's really risen up the agenda. And I think it's a factor of a number of things, but it's no doubt that the major loss events that we've witnessed in the last 3 or 4 years, including in some of the most luxurious and, dare I say, fashionable parts of the world, or the most sophisticated industrial regions of our most advanced economies, coupled with COVID, and COVID is part of a broader sort of an environmental set of risks and our relationship with sort of nature. I think that's been the shock. This combination of factors, coupled with a growing realization as we go through financial regulation that these risks are going to have to be understood and disclosed and managed as contingent liabilities. I'm sure we're going to come on to that sort of theme a bit later on, but no doubt this is an inflection point, Glasgow, for both finance and resilience. And for those of us who work in both of those areas at the same time, it's both an exciting time, but one filled, I think, with real responsibility, because if we get this right, we will save billions of dollars, but critically millions of lives and livelihoods over the coming decades. If we don't take advantage of this and get it right in the next 5 years, people are going to suffer now and in the near future who shouldn't have to. And that's our duty to confront through the power of finance.
Brilliant, thank you, Rowan. Nicola, your perspective, because I know you've been here, I think since the start. Certainly I bumped into you early on and you've been launching reports. What's your perspective as to how this is developing?
Yeah, well, thank you very much, Amaral. And I think this adaptation resilience does feel very, very different at this COP. And also, it's wonderful that we're talking about it at the Green Horizon Summit as well, because this is a fundamental part of action on climate change. And I would raise sort of two things in addition to Rowan's point. So one is that adaptation resilience, I think, has always felt within COP like part of the aid agenda. which is obviously a critical part of this. Mobilising finance to meet the 100 million goal is obviously absolutely critical, and we're not there yet. But I think there's also now a realisation, partly because of the events that have happened in the last few years, that this has to be bigger than that as well. This is about how do we get finance to flow in the right direction to enable adaptation resilience. And I gave a statistic earlier in the week, which I'll give again, and that's that right now the UN EP report that was launched just yesterday told us that adaptation finance is at 80 billion, which is a great achievement per year. But infrastructure finance globally is 2.7 trillion a year. So if we're trying to flow, it's like there's two flows going in opposite direction. There's a huge tidal wave of finance going into infrastructure. And the adaptation finance is a tiny flow in the other direction. And what we need is that big flow all to be flowing towards adaptation resilience. I think that's the critical thing. So I'd say that's my point one. It's sort of bringing it out of just an aid agenda and into the core finance agenda. And the other one is about time scales, and this links into Rowan's point. I think the impacts of climate change were always seen as being in the future. So it was, mitigation is now, adaptation is preparing for the future. But that's not the case. The climate emergency is already here, and we've seen that even in the developed world. And so I think that timescale issue is now seen as, this is a material financial risk today, and is a risk we need to manage today, and brings benefit from managing today.
And that the fact that this is happening right now, I mean, even as we arrived at COP, as we came to COP yes. over the weekend, the Environment Agency, we have responsibility for flood and coastal erosion risk management. We know that for every household that is flooded, at least 16 other people are affected by the infrastructure services that we provide. We were issuing warnings of significant flood risk in Cumbria on Thursday into Friday. And whilst sadly there were a number of houses flooded, we also know that at least 1,400 homes and properties were protected because of the investment that the UK government has put into our flood work over the last decade. So it also shows that with this kind of investment, you can start bringing resilience, protecting communities. I'm really keen to bring you now in, Luiz, because you're perhaps observing from a distance what's going on here in Glasgow. WRI has always done fantastic work in this space. You were partners of the Global Commission on Adaptation. So what are you seeing and hearing that gives you hope for this agenda? Over to you.
Well, thank you very much, Emma, and it's a pleasure to be here sharing this stage with colleagues. The financial activity is basically one that it's based on making decisions based on incomplete information, right? So how do we minimize and maximize the input is the core center of financial activity. And as we bring climate risk into that equation, and I think that's what is different, Emma, that is what is happening now. There's this recognition that within the financial risks that we have, the risk of resilience is now center of the financial economic activity. But the next question that we ask then is, what do we do about that? And at WRI, we are a global research organization, and we really believe that what does not get measured does not get managed. And we need to maximize the amount of information so we can measure and then manage those risks. So to summarize, I think what is different is that there is this recognition that this resilient risk is really key within the financial activity. That's what is changing. But once that is done, we still have steps to get to the place in which this is really incorporated. And we always see things, at least in WRI, through a counted, change it, and scale strategy. So we first need to measure the size of the problem, then we need to implement the change to tackle that problem. And finally, we always need to scale that up. So once the recognition, which we're having now at COP, is happening, the next three things that we need to do is really focus on the data availability. I saw it was something that was discussed on the panel. How do we get the information to be able to make decisions and to measure what is happening in terms of that risk? And technology has been advancing quite fast to allow us to do that. So this is the first step. The second one is that we need to change it, and the financial sector is really based on standardization of processes and methods. So we're not going to go get there if each different financial institution is having a different way to measure those impacts. So we need a coalition to standardize the way that those things are done. We had 100 years history on how to standardize credit reporting, right? And that's the only way we are very efficient in doing that. So we need to have that standardization within the industry. And finally, of ability. If only 2 or 3 actors do that, that's not enough. We really need to incorporate that. And again, technology can help making that type of assessment really accessible to everyone.
Brilliant. So Nicola, coming back to you and that technology piece, you're looking at geospatial data, how we can use technology to help inform us of some of the steps that we need to take from an investment perspective. Do you want to tell us a little bit more about your research?
Yeah, well, I'll tell you about the research, but also a great initiative that we've been working on jointly. So I think one of the exciting things now is that with new data that's available through Earth observation, new techniques like artificial intelligence, we can actually now, for the first time, map the globe. So we can gain a consistent view of risk and make that available. You know, it's low cost. You can access it, make it available to everyone, and that ability to level the playing field in access to information is absolutely critical if you really want to bring risk into decision making at all levels, from investors in infrastructure down to individuals in country. That shared understanding of risk is critical. And one of the things that we've been working on actually together and with other colleagues around the world is on trying to bring together the information that's available on a common platform. And Luiz made this point as well about having that sort of shared way of thinking about risk, a sort of shared standards. A critical thing that we've been particularly focused is on the extremes, because that's very much missing in our understanding of risk. So what are the impacts of extreme weather events? It sounds crazy to have to be saying that, because we all know as individuals that it's the extreme weather events that are the ones that create the biggest damages, both economically and to individuals. But that understanding of those risks has been missing today, and that's why working with the insurance industry has been extremely important in bringing that understanding from that very long experience. And the other side, which has been mentioned in across the summit today, is on the systemic risk side, because we know that actually it's how systems function that create the risks. And you mentioned the train system in the UK and the impacts over the weekend in just getting to Glasgow. Those infrastructure systems are critical. So that's another piece of that we've been working on, particularly in the Centre for Greening Finance Investment, understanding infrastructure risks. And we know, for example, from research from the World Bank, that in emerging and developing economies, while the direct risks to infrastructure are, say, 20 billion a year, the indirect risk can be more than 600 billion to economic development.
And I think that mindset change from thinking about the asset, the resilience at an asset level, where we've seen many examples of a building being resilient, but that's got nothing to do with the rest of the community. People can't get to it, people can't get away from it, to the systemic risk. And Rowan, this is something that Willis Towers Watson, through the various initiatives that you've been involved with, are really taking a lead, but a lead in a way that's through collaboration and unique collaborations, because it's not just the industry, it's the civil engineers, it's at a country level. Tell us about some of those projects and how you're making it very practical.
Yes, no, I'm lucky enough to be involved with a couple, the Insurance Development Forum, which is helping to drive some of these broader access to risk information that Nicola just mentioned, but one that we're lucky enough to work on, the Coalition for Climate Resilient Investment. And I suppose what I'd like to try and convey to everyone is how quickly things are going to change in the financial sectors that we all work in. And I want to sort of paint a picture through the story of the coalition. So I'm lucky enough for 2 reasons. I did geography, not economics. I feel very lucky that I did that. It's taken 30 years for it to become fashionable, but it is. So I did geography, and I did reinsurance, not banking. And I feel that at long last, some of those skills are being useful. And I was lucky enough to be part of the catastrophe risk modelling revolution in the reinsurance world that took us from ruin to resilience, by basically marrying engineering metrics with actuarial science and human and physical geography, and stress testing in ways that have never been done before, with capital requirements driven not by the real world that had happened, but the modelled world which could. Now, the challenge is, as Nicola's just outlined, it is possible to get the sort of data assimilated that can help people understand risk. But the real challenge that is above and beyond that when it comes to how markets work is how do sectors consume that information inside the DNA of banking transactions, regulatory sort of reporting, all those things. And I saw it took 30 years for the insurance sector to take the sort of information you put on your household insurance policy about the age of your house and how it gets into the DNA of capital and pricing. We realized, because we felt that those same techniques, in principle, needed to be applied in the world of investment. But we realized that no matter how much we tried to push this to the investment community, particularly the real asset investment community, it wouldn't work until that particular ecosystem, the investors, the credit rating agencies, the actual engineering firms, were using the same sort of language. So about a couple of years ago at the UN Climate Action Summit, with a lot of help from a lot of friends, including you, Emma, we formed something called the Coalition for Climate Resilient Investment. Yes, to understand the risks from out there, but critically work with that financial sector to say, what do we need to incorporate physical climate risk within the cash flow modelling and projections that make infrastructure work, to show that basically if you have to increase a little bit of capital expenditure to make an asset viable or more resilient, at the moment you're penalised for that. Because at the moment, the risks of events happening that could damage that asset or even destroy it are not included in the financial risk assessment. So over the last 2 years, I'm so pleased we've got a sort of a revolution that whether it's investing in an individual asset, a bridge, a power station, a hospital, or looking at the risk to an overall system, we're beginning to have the code that allows the value of resilience to be imputed through the assessment of risk. And ultimately, it's that transition which means that it's not going to be how many hundreds of millions we can get into resilient investment. If we change the rules of the game, if we, to quote Adam Smith, retrain the invisible hand, everything will become resilient. Because that will be how the economics works, which drives who wins, who loses, and where the money goes.
And that's such an appropriate line to take, particularly here in Glasgow. And that fact that, as Nicola's already said, that we have so much investment potential going into infrastructure. I know from my work with the UK government that the Environment Agency and DEFRA, with their flood budget, a couple of years ago, we were 1 billion of about 40 billion investment across different departments and different infrastructure sectors, roughly 50-50 private sector, public sector. All of that infrastructure needs to be built in a net zero way. All of it needs to be resilient, and we need to take account of nature and nature's recovery as well. Nicola, your research, how does that, and your tools, how does that help us in this journey? Are there some specific examples that we can talk about?
Well, one of the projects that we've been working on, so Rowan has introduced CCRI, and I know it's very close to your heart as well, Emma. So one of the things that we've been working on at Oxford is a brilliant collaboration in Jamaica, where we're actually working in Jamaica using these infrastructure analytical tools that I mentioned to really work with the Jamaican government to help them think about, one, how do we bring in more private investment into infrastructure in Jamaica and make that resilient, but also about the public infrastructure as well, and starting to bring that understanding of risk into public infrastructure investment. The other side that I would just drop in, which Rowan mentioned, is bringing it into government decision making as well around how to manage fiscal risks. So bringing that understanding of risk into public financial management, bringing it into fiscal risk assessments, and actually having that at the core, using that information at the core of financial decision making within government in ministries of finance, we've found is absolutely essential in then creating the right signals across the economy. So, within infrastructure investment, within regulation across the board, within agriculture, all sectors. So having that signal in public financial management, and that's another really important application of risk information.
And one of the things that has been great is that the UN Secretary General has challenged the initiative to work with, I think it's 25 different developing countries by 2023, if I've got my dates right. I mean, that real acknowledgement that we're doing something good, but that we need to do even more of it. Luiz, I know you want to come in.
No, thank you. It's been a great discussion. I just wanted to take back one thing that you mentioned, Emma, on the usual philosophy again. And I think physical risk within the finance sector is something that is by definition perfectly explicit, right? It was discussed before. The physical risk of an asset is not the same if it's located here or if it's located elsewhere. Obviously, that together comes to a systemic risk, but ultimately the risk is at the asset level, and that's geographically explicit. And that means that using that geographically explicit information is something that the finance sector cannot really get away from it. It's something that, to the point that it was made, is going to become implicit within the financial activity to really mapping and understanding the risks of your assets. And I just want to close by giving you one example. Before we move into my background is actually on agricultural finance. And that's one sector that has been doing a little bit of that physical risk assessment for quite some time. The only difference is that it has been done on the short term. If you're financing, a corn area, you need to know if that area, the weather is suitable for corn, right? So that type of assessment is something that is already embedded within the agricultural finance activity. What we need to do now is really expand the timeline of how that is done, right? Instead of looking what is the risk for the next year, but looking what is the risk on the next 10 or 20 years of that investment. So I think there's a lot to draw from that. And to conclude, I think that's the train has left the station in terms of using of that geographic explicit. We see many financiers that are already investing into that. The ones that have not probably are already missing out a little bit. But to what was said before, way on how to better use that technology. Well, now we can see on a 30 by 30 meter resolution if trees are falling anywhere in the globe. So we really have the availability. There are two key problem statements to really take that mainstream. The first one is data is only good as the problem statement that we have. So we have very clear problems. Don't get underneath too much data without understanding that. And the second most important one, which I had said me to touch base again, is standardization of processes, methods, and policies. If everybody is doing its risk assessment differently, it's very hard to have comparing apples to apples, and it's very hard to make that a common on the sector. Very few sectors are as regulated and standardized as the financial sector. So we need to push forward towards standardization of processes to really make that mainstream.
Thank you, and thank you for bringing in the agricultural sector as well. For the UN report that was published yesterday on the adaptation finance gap showed that it's both infrastructure and agriculture where we have the most to catch up and get money invested in a very different way. So my opening comments, I talked about the need for the race to resilience to catch up and accelerate with the race to zero. What are the things that you think we can best do as we prepare? I'm already thinking about the next COP, which is going to be in Africa, going to be in Egypt, a continent very much at the heart of the adaptation and resilience debate. So what do we need to be working on to make sure that this drumbeat, this momentum keeps on driving ahead? Perhaps, Luiz, if I can bring in you first, and I'm going to take final comments from each of the panelists. Over to you.
Well, thank you so much. I'll be very short. I think just mainly two things, Emma. Well, the first one, again, I'll repeat, is kind of the standardization, getting the industry together to come and create what are the standards, similar to what was done on the TCFD, or something that is being done today with Science-Based Targets Initiative, really not that standardization. The second one, I think, the agricultural piece that you mentioned specifically, which is my area of expertise, we need to bring that to the day-to-day of the financial product farmers are used to. We usually are discussing green bonds, the more sophisticated issues, but the lion's share of financing to agriculture is really turning capital, right? It's short-term finance. And that's how we finance agriculture. How can we bring resilience within that financial product? How can we make farmers perceive and make calls based on what they're used the most when it comes to financing to them? I think that's the second thing that we need to be looking at.
Thank you. Nicola.
I'll give one quick top down and one bottom up. So on the top down, I think we talked a lot about investment and infrastructure. Within the financial system, we need physical risk to be on an even par with transition risk. So for example, TCFD that Luiz mentioned includes both, but everyone's talking about the transition and not the physical. So I think we need to bring physical up on a par, and we have the data now to do that. And I think that we also need to, when we're talking about aligning financial flows, it shouldn't just be with net zero, it should be with net zero and adaptation resilience goals. It needs to be net zero and climate resilient. And on the bottom up, because talking about Africa next year, we need support to bring in finance into infrastructure, and that includes things like de-risking finance, it includes things like supporting early stage projects, so we need that bottom up work as well.
Brilliant. And Rowan, we're almost out of time.
The data's been dealt with, great work at Oxford. Regulatory mandates, some great research has come out from Cambridge. We had the FSB here yesterday. Some real changes coming down the track in regulatory mandates and contingent liabilities and duties. That's key. The final one, though, is fashion. Everyone is keen to be net zero. We need to create that sense of collective responsibility for each other. What do we owe each other locally and globally in terms of resilience? And that is the cultural shift that we need to make. We need beverage, but we need beverage for resilience.
So a final word from me. I want to thank Luiz, Nicola and Rowan. I think we need to get physical so that we are adapting rather than dying. It's so important that we get the resilience agenda right, and we're racing to resilience. Thank you to you all.
Thank you, Emma.
Thank you, Emma.
Very much. Thank you, Luiz.